analysts are calling it a double crisis. The pandemic and fast falling oil prices have strained Houston's real estate and lodging market. New data reviewed by CNBC shows nearly 70% of hotels in Houston have defaulted on their CMBS loans during the pandemic. It's one of the highest rates in the nation, surpassing New York, Chicago, even other metropolitan cities in Texas, like Dallas and Austin. Now, during the oil boom, developers descended upon the self-proclaimed energy capital of the world. It's one of the fastest growing markets. In fact, Houston opened more hotels than any other U.S. market in 2019, even more than Manhattan, which speaks to why the city is uniquely exposed to this big drop in business and leisure travel. SunTrust analyst Greg Miller says expect more foreclosures in Houston and conversions, that's hotels, turning into residential use if demand doesn't pick up this fall. Kelly, I was speaking to one hotel owner who manages 5 properties in Houston. He says he checks the price of oil every day, not because he owns energy stocks, because it's so tied to his business and occupancy rising.
I can't imagine 70% of the hotels going under, but are we facing that scenario?
So a couple different options that these hotel owners are faced with if they cannot pay the loans that they owe to their lender or bank. One is they can look for forbearance options with their lender, or they simply default, and over time, if they do so, they're going to be forced to hand over the keys, and that, of course, leads to foreclosure. So a couple different scenarios that could come out of this situation.
Right, or maybe, like you said, they try to do some conversions. Still, I'm shocked that it's that bad in Houston. It's a good reminder of the toll that low oil prices have taken.
Right.
Seema, thank you very much.